following presentation is brought to you as a courtesy of Forex Academy. This is part of our service, Courses on Demand. If you find this interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all of our services for free. Your like is also highly appreciated. Enjoy!
Market positioning is all about the big players, the big traders in the marketplace that are looking for these big trades. They don't necessarily involve themselves with short-term scalping or very short positions in the marketplace like many traders do. What they look to do is, particularly hedge funds, develop a very consistent, very well thought out fundamental trade decisions based on a lot of acute fundamental analysis and decision making. For many large market participants, such as financial institutions and hedge funds, the very essence of their trading will target long-term price changes as a result of changing macroeconomic variables. Their decisions are thus a result of very carefully conducted fundamental analysis. So this can help us as well if we know a large institutional is positioning itself within the marketplace. If we have a feeling or a sense or perhaps news that would dictate with which direction they're looking to trade, that will certainly aid us in our decision as well. In the prelude to large news events, such institutions will build large, long, or short positions in the marketplace. The objective is either for protection from risk or from profit. Obviously, profit being a main objective for long-term fundamental price change. Why would they look to perhaps protect themselves from risk? Well, if they perhaps know that there's going to be a large appreciation or depreciation in the currency, they may have a lot of other assets denominated in that currency, and the objective therefore could be to position in the market to actually look to hedge that risk within the currency markets themselves. So with many different objectives there, they look to take these huge positions in the market. It is often these large market participants that cause large swings in volatility when realities do not meet the market expectations. And that's absolutely the case. What we'll do is actually look at a few examples here to explain what we mean when we see market positioning go wrong. Here we have the Brexit vote, and this is the cable or pound US dollar market. Obviously very significant in terms of a world non-economic event, but it was a huge piece of news and a huge shock to the market at the time, and obviously we can see how the currency itself reacted. What we see is fear within this price charting moving down. We see a little bit of a price channel form with a support level of resistance. However, that fear and uncertainty leading up to the weeks just before. These are daily candlesticks. The week before the actual decision shows that there is some fear and uncertainty and some money coming out of sterling in relation to the dollar. What we then see is market positioning. I do remember 1 week before we seen a lot of fundamental analysts coming out with their forecasts to say it was more or less a done and dusted deal, that there was no way the UK would be leaving the European Union. And we see this reflected in the market price. Market positioning then hits the bottom with many green candlesticks in a row, suggesting that this has been priced in. These large market participants are really pricing in a stay vote that the UK will most certainly stay within the European Union, and that's reflected as the price trades up within this week leading up to the decision itself. Then what we see is the Brexit leave vote, a massive shock to the market. We see some serious volatility to the upside and downside, and then the currency actually trades down the whole way from around 147 to 133 within 1 day, trading an absolutely huge percentage loss in the overall price of sterling. A huge shock to the market. We can see that it's technically very significant given how market positions were actually gearing up for a stay vote. They were all proved wrong, and that's inevitably, if we look closer at this price action, what we see within the price action. The candlestick structure here tells us a fascinating story of how market participants began to prematurely price in the expectation of a Brexit stay vote. heavy long positioning accumulated in the pound US dollar almost a week before the fundamental decision was made. So they're trying to position, they see a very strong probability that the UK will obviously vote to stay and sterling value will increase over the medium to long term. Certainly that does not happen. They are proved wrong and they suffer the consequences.